Welcome, curious minds. Have you ever found yourself wondering what truly sets apart the titans of the financial markets? Those individuals who seem to effortlessly navigate the complexities of global trading from the rest of us?
Yeah, like, is it some innate, unteachable talent they're born with? Or is it simply a matter of grinding away for endless hours?
Exactly. Or maybe, as some academics suggest, it's all just random chance and consistently beating the market is actually impossible.
Well, that's the big question, isn't it?
It is. And today we're taking a deep dive into a foundational text that challenges many of those assumptions. Market Wizards, Interviews with Traders by Jack D. Schwager. Get ready to unpack some extraordinary insights.
Our mission today really is to distill the most potent nuggets of knowledge from this remarkable book. We want to give you a shortcut, sort of an accelerated understanding of what truly makes elite traders tick. We'll journey through an array of diverse trading philosophies, delve into the absolutely critical realm of risk management, and perhaps most importantly, shine a bright light on the often overlooked psychological elements that truly distinguish these exceptional individuals.
Yeah.
And everything we share, it's drawn directly from the experiences and hard-won wisdom shared within Schwager's seminal work.
Schwager himself actually embarked on this project as a profound quest for self-discovery. He openly recounts how, despite his extensive market knowledge and hands-on experience, his own trading success felt limited, almost leaving him with a sense of failure compared to what he believed was his true potential.
That's interesting, even though he'd had some success.
Yeah, he had managed to multiply small accounts, those under $10,000 more than tenfold on 2 separate occasions.
Wow, okay.
Yet he found himself consistently hitting a wall, unable to expand that equity much beyond that initial hurdle. So he turned to those who had succeeded, asking them directly, what are the key elements to your success? What approach do you use? What trading rules do you adhere to?
He wanted to know the secret sauce, basically.
Pretty much. He desperately wanted to understand why his earlier mistakes, like being wiped out despite being intellectually convinced he was right, were so common, and how the truly successful navigated such pitfalls.
And before we introduce you to these extraordinary market wizards, it's absolutely crucial that we address a prevailing academic theory that has underpinned much of financial thought for decades, the efficient market hypothesis, or EMH.
Right, the EMH. Gotta talk about that.
Exactly. This theory suggests that asset prices already reflect all known information. In essence, it posits that any new information is instantaneously discounted into prices, making it theoretically impossible to consistently beat the market through skill alone. Any outperformance is simply attributed to sheer chance.
So pure luck, according to the theory.
According to the theory, yeah. However, Schwager argues that this premise is conceptually flawed. He highlights a critical distinction. Even if everyone had all the same information, there's no logical reason to assume they would arrive at the same decision regarding the appropriate price of a market or security.
Okay, that makes sense. Like in chess.
Precisely his analogy. Think about a chess tournament. All players know the same rules, they have access to the same books, and records of past games by world champions. Yet only a small minority truly excel.
Right.
The markets, an even more complex dynamic game with constantly changing variables, should be no different.
That's a really powerful analogy. So if I'm understanding correctly, the EMH essentially assumes a kind of collective, instantaneous, perfect understanding and rational action from all market participants. Is that where it falters?
Precisely. And this is indeed where the theory truly falters in the real world. The EMH fundamentally fails to incorporate the profound impact of human emotions on prices.
Ah, the human element.
Exactly. Sometimes these emotions, like euphoria, can cause prices to wildly overshoot any reasonable definition of fair value, what we commonly refer to as market bubbles.
You've all seen those.
Oh, yeah. And at other times, emotions like panic can cause prices to plunge far below fair value, leading to market panics. This directly contradicts the EMH's assumption that prices instantaneously discount all known information in a purely rational manner.
Because people just aren't purely rational, especially with money on the line.
Anything but, right.
And it's not just a theoretical disagreement, right? Schwager points to some pretty astounding empirical evidence that challenges the EMH head-on, almost as if the market itself is actively disproving it.
Absolutely. One of the most compelling examples is the astounding 29% fall in S&P futures on October 19th, 1987, what we now know as Black Monday.
Black Monday, yeah.
If the EMH were true, the probability of such an event occurring would be an unfathomably remote 10^160.
10 to the power of negative 160. That's basically zero.
It's functionally zero. To put that into perspective, it's roughly equivalent to picking a specific atom in the entire universe at random, and then, in a completely separate and independent trial, randomly picking the exact same atom again.
Okay, wow, that's not happening.
Not happening. It's an astronomical impossibility. Beyond such single dramatic events, Schwager also notes that the consistent long-term track records of some of the market wizards themselves are, by definition, a statistical impossibility under the EMH.
Their success just shouldn't be possible if the theory holds.
Exactly. Their consistent outperformance simply shouldn't happen if the market were truly efficient.
So the efficient market hypothesis suggests you can't beat the market, which for many sounds like disheartening news for anyone hoping to achieve outsized returns.
It can sound that way, yeah.
But the fantastic news, which Schwager thoroughly explores, is that he believes the EMH is deeply flawed on both theoretical and empirical grounds. He asserts that, yes, it is possible to beat the markets, though he quickly adds that it is very difficult.
Which feels more realistic, doesn't it? Possible, but hard.
Absolutely. And this belief sets the stage beautifully for our deep dive into how these extraordinary wizards manage to do precisely that. It also brings up an interesting point about innate talent versus hard work. Schwager draws an analogy to running. Most people can train to run a marathon.
Sure.
But only a select few possess the innate physical characteristics to run a 2.15 marathon. Similarly, he suggests that while proficiency in trading is absolutely achievable with hard work, performing at an elite level often requires some degree of innate talent or an inner radar that gives them a distinct edge.
So work hard, but also maybe find what you're naturally wired for.
Exactly. It's about finding what you're naturally good at and then honing it with relentless effort. Okay, let's unpack this and begin our journey into the often misunderstood yet incredibly dynamic worlds of futures and currencies. These are markets that offer immense opportunities for those who master them.
Absolutely. Big, fast-moving markets.
The futures market, for instance, is not just a niche. It's incredibly fast-growing. In 1988 alone, the dollar value of all futures contracts traded in the U.S. exceeded an astonishing $10 trillion.
$10 trillion. That's a mind-boggling sum, isn't it? Clearly indicates there's much more to it than just the old image of, pork belly contracts.
Definitely not just pork bellies anymore.
Indeed. And then there's the interbank currency market, where global currencies are traded directly between banks. Here, the liquidity is enormously better, transaction costs are much lower, and it truly is a 24-hour market, allowing for continuous trading around the globe.
So always open somewhere.
Always open somewhere. Unlike futures, where contract sizes and dates are fixed, the interbank market can tailor hedges. That is, financial instruments used to reduce risk for any customer's specific needs, making it highly efficient for commercial activity.
Makes sense for businesses needing specific currency amounts.
Exactly. And while hedging constitutes the bulk of activity, banks and a few large, sophisticated players, like some of the wizards we'll discuss today, also act as principal speculators within this market, seeking to profit from currency movements.
Let's start with Michael Marcus, a figure described by Schwager as one of the finest traders. What's truly remarkable about his story is that his beginning was anything but auspicious. He started with a truly humbling record. His first 8 trades were all losers.
Ouch. 8 straight losses. That's tough.
Right. He actually wiped out his initial $500 stake, then another $500. He even had to cash in a $3,000 life insurance policy against his mother's wishes just to get back into the game.
Wow. That's some serious desperation and commitment right there.
It really is. His breakthrough, however, came after reading Chester Keltner's work on trend analysis and a stroke of sheer luck, a trade in corn during the 1970 corn blight, which turned that desperate $3,000 into a princely $30,000.
A huge turnaround, a classic rags to riches, or at least rags to stability story, initially built on a lucky break, as he called it. Marcus's journey, though, provides crucial early lessons in risk and humility that every trader should internalize. He recounts a devastating second attempt at capitalizing on corn blight. Buoyed by his initial success, he borrowed $20,000 from my mother.
Oh.
Yeah, added to his $30,000 and bet everything, putting $50,000 in margin on corn and wheat.
All in, with borrowed money.
All in. For those unfamiliar, margin in trading is borrowed money used to increase your potential returns, but it also amplifies your losses massively. He wasn't making money initially, but prices held steady due to blight fears. Then came the infamous Wall Street Journal headline that read, More blight on the floor of the Chicago Board of Trade than in Midwest cornfields.
Oh, brutal headline.
Absolutely brutal. He watched paralyzed as the market locked limit down, meaning it dropped by the maximum allowed amount for the day, and he was unable to exit his position.
Couldn't get out.
Couldn't get out.
Yeah.
This single event completely wiped him out. The core insight here is that past success, especially if based on luck, doesn't guarantee future results. Overcommitment and paralysis in the face of a rapidly moving adverse market are brutal but common lessons.
And the hits just kept coming for Marcus, even after he started winning consistently. His most devastating experience wasn't even a loss, but a profitable trade where he got out prematurely of soybeans.
Ah, the one that got away. That hurts too.
Right. He recounts watching in agony as soybeans went limit up for 12 consecutive days after he had already exited. The market kept rising without him.
12 days limit up. That's torture.
He even tried tranquilizers to dull the mental anguish of missing out, which led to a dramatic, almost comical fall on a subway, marking what he calls his low point.
Yikes. Just shows the psychological toll, doesn't it? Missing out can be as painful as losing. These painful experiences forged Marcus's core trading philosophy, which is incredibly insightful. He learned the hard way that if you don't stay with your winners, you are not going to be able to pay for the losers.
That's huge, letting profits run.
It's crucial. It's counterintuitive for many who prefer to lock in small gains. His brutal grain trade during the non-existent corn blight, where his $30,000 was wiped out by betting it all, had a dramatic and lasting impact. It's no accident that his very first rule for the average trader is simple, yet profound. Never commit more than 5% of your money to a single trade idea.
Only 5%. That's strict risk control right there.
Absolutely. The core insight here is that position sizing is the ultimate risk governor. It's not just about limiting potential losses on a single trade, but about ensuring you survive to trade another day, especially after learning from desperation. Marcus's story truly underscores that internalizing lessons from painful mistakes is paramount to long-term survival and success in the markets.
Building on the theme of disciplined risk-taking, let's turn to Bruce Kovner, aptly dubbed the World Trader. He began his journey not in finance, but as an academic, intellectually curious and driven.
Yeah, different background.
In the mid-1970s, he immersed himself in market study, reading everything he could get his hands on. He particularly fell in love with the yield curve, which, for our listeners, is simply a graphical representation showing the interest rates of bonds with different maturities at a specific point in time. It's a key indicator of economic health. His very first trade exploited price distortions in the nascent interest rate futures market, turning a modest $3,000 stake into $4,000. It was a textbook win, and he was immediately hooked by the intellectual challenge.
Kovner's second trade, though, an intra-market copper spread, offered a different, crucial lesson. The critical importance of timing.
What's an intramarket spread again?
It involves simultaneously buying and selling different contracts of the same commodity, but with different delivery months, aiming to profit from the price difference between them. He was too early on this trade, meaning his timing was off, despite his fundamental idea eventually proving right, and he initially lost money.
Right. So being right isn't enough if the timing's off.
Exactly. Then he faced a critical margin call issue with his initial broker. A margin call occurs when the value of a trader's margin account falls below the broker's required minimum, forcing the trader to deposit additional funds or close positions.
Stressful stuff.
Very. His broker abruptly raised your margins from $400 to $2,000 per contract on his spread position, arguing it behaved like a net long position, meaning the spread, despite being designed to be relatively neutral, was essentially behaving like he was just outright buying copper.
So the broker didn't really understand the trade.
Apparently not, or didn't like the risk profile. Furious at this unforeseen obstacle and the lack of understanding from his broker, Kovner promptly moved firms, and eventually he managed to pyramid his position, meaning he strategically increased his position size as the trade became profitable to a significant $35,000.
So he stuck with it and turned it around.
He did. But this early experience really hammered home the real-world challenges of executing even a theoretically sound trade and dealing with unexpected operational hurdles.
That experience sounds like a trial by fire. It makes sense, then, that his mentor, Michael Marcus, imparted two incredibly critical lessons that profoundly shaped Kovner's career. First, Marcus showed him the true potential of the game, that you could make $1 million.
Opening his eyes to the possibilities.
Right. This wasn't just about money, but about envisioning what was truly possible. Second, and perhaps even more profound, Marcus taught him that you have to be willing to make mistakes regularly. There is nothing wrong with it.
That's a huge mental shift, isn't it? Permission to be wrong.
Absolutely. This liberated Kovner from the crippling fear of being wrong, which can paralyze many traders.
Kovner himself identifies two crucial elements for his own extraordinary success. First, the ability to imagine configurations of the world different from today and really believe it can happen.
So thinking outside the box, challenging the consensus.
Exactly. This isn't just about being right. It's about the mental agility to challenge consensus and prepare for outcomes others might dismiss as impossible, giving you an edge in market turns. And second, his ability to stay rational and disciplined under pressure.
Emotional control.
Yes. He views a good trader as strong, independent, and contrary in the extreme, emphasizing discipline and a willingness to make and accept mistakes as key traits. The core insight here is the blend of visionary thinking and unwavering emotional control.
A powerful combination.
Indeed. Interestingly, he also touches on the impact of unexpected information, noting that the Soviets occasionally had advanced information in the market due to their intelligence service, a fascinating, albeit rare, glimpse into the less visible forces at play.
Wow. And beyond strategy, Kovner was a master of risk management, which clearly complements his emotional discipline. He designed a lot of risk management systems, paying strict attention to the correlations of all my positions, and diligently measuring his total risk in the market every day.
Very systematic about risk.
This meticulous, almost engineering-like approach to risk, rather than simply chasing gains, is a powerful recurring theme among these wizards. It's about understanding the downside before you even consider the upside. Moving from one legend to another, Richard Dennis, often called one of the foremost trading legends of his time, began his career humbly as a runner on the exchange floor with a mere $1,600.
Started small.
Very. But he's most famously known for his groundbreaking trader trainee program in the 1980s. He sought to prove a controversial point, that trading skills could actually be taught systematically rather than being purely innate talent.
The nature versus nurture debate in trading.
Exactly. From 1,000 applications, he selected 40 people for interviews, then picked 10 to train, starting each with a substantial $100,000 of his own money. These trainees became famously known as the Turtles, a playful reference to growing traders, just like they grow turtles in Singapore.
The Turtles. That's a legendary story. This experiment was designed to be a definitive test of his hypothesis.
Right.
Dennis consistently emphasized trend as the main thing that eventually gets us in a trade, stressing the paramount importance of being consistent in one's approach.
So follow the trend, stick to the plan.
That was his core philosophy. This highlights the power of following the prevailing market direction. He held the fascinating belief that he could trade without knowing the name of the market, because he saw patterns as very similar across different commodities, a true testament to technical analysis.
Wow. Didn't even need to know what he was trading.
That was his claim, for commodities at least. However, he did consider stocks to be probably separate due to their price fluctuations being closer to random than those in commodities, attributing this to a lack of sufficient fundamental information per stock to create strong, discernible trends.
Interesting distinction.
The core insight here is that identifying and adhering to a clear trading edge, like trend following, is more important than specific market knowledge.
Despite his phenomenal long-term success, Dennis weathered dramatic setbacks, including a 50% loss in his public funds in 1987-88, which triggered the 50% loss cutoff point that he had established for those funds.
A huge drawdown. That must have been tough.
Immense losses, yeah, in his personal account too. But what truly sets him apart is his ability to remain unshaken during such periods, attributing his resilience to accepting losses as simply part of the game.
Just the cost of doing business.
Exactly. His confidence remained unblemished because he believed in sticking to his basic strategy, knowing he would eventually rebound. This speaks volumes about the emotional detachment required.
He also held strong, often controversial views on program trading, which refers to large, computer-driven buy-or-sell orders, considering complaints against it as inanity and a convenient scapegoat for poor performance, particularly in the wake of the 1987 crash.
Didn't buy the excuses.
Not at all. When asked about luck, he famously stated, in the long run, zero, implying that sustained success is not about chance. He firmly believed that proficiency is achievable with hard work, but performing at an elite level requires some degree of innate talent.
Back to that talent versus hard work idea.
Right. And crucially, he estimated that an astounding 95% of his profits came from only 5% of his trades, highlighting the immense importance of not missing those major opportunities and the danger of holding too rigid an opinion on a market, which could lead one to miss a significant trend.
Wow, 95% from just 5%. So you got to catch the big ones?
You absolutely have to catch the big ones. The core takeaway here is that long-term success is about capturing big moves and having the mental fortitude to weather losses, not about being right all the time.
Paul Tudor Jones, a name synonymous with aggressive, successful trading, is known for his incredible intensity and steel-hard emotional control. Schwager recounts a striking instance where Jones sustained a $1 million loss in S&P futures during an interview without so much as a visible reaction.
$1 million gone and didn't even flinch. That's something else.
Incredible detachment, right? His unparalleled flexibility is perhaps his greatest asset. He's capable of a 180-degree shift in opinion within a short time span, allowing him to quickly abandon positions and even join the other side when evidence suggests his initial projection was wrong.
He's not afraid to admit he's wrong and switch sides immediately. That's rare.
Very rare.
Jones learned a great deal from his first mentor, the legendary cotton trader Eli Tullis. Tullis taught him about moving volume, how to execute very large positions without unduly impacting the market, which is a nuanced skill.
Like how to be the elephant in the room without making too much noise.
Kinda, yeah. He also instilled in Jones the contrarian idea that even though markets look their very best when they are setting new highs, that is often the best time to sell.
Buy low, sell high. But maybe sell at the high.
Or just as it's making the high, yeah. Jones's own infamous 1979 cotton trade serves as a powerful cautionary tale. He added to a losing position based on a macho-type bid at a new low, only to realize immediately he was wrong, leading to a substantial loss. This, he says, was one of his most important lessons.
Learning the hard way not to double down on losers.
The core insight here is that acknowledging and rectifying mistakes swiftly, even if it means doing the opposite of what feels right, is paramount to survival.
He lives by a set of strict trading rules that distill his hard-won wisdom, almost like commandments for navigating the market. These include, don't ever average losers.
Rule number 1 for many traders.
Meaning, don't buy more of something that's going down hoping it will turn around. Also, decrease your trading volume when you are trading poorly. Increase your volume when you are trading well, adapting your risk to your current performance.
Smart. Press your bets when you're hot, pull back when you're not.
And crucially, never trade in situations where you don't have control, such as immediately in front of key economic reports, which he considers pure gambling. His ultimate overarching rule is play great defense, not great offense.
Defense wins championships, right? Protecting capital.
That's the idea. He advises, always think of your entry point as last night's close to avoid complacency, and emphatically states, don't be a hero, don't have an ego, always question yourself and your ability.
Humility, even at the top.
He even admits to being more scared now than I was at any point since I began trading because I recognize how ephemeral success can be. This highlights that even the greatest traders maintain a healthy sense of humility and fear, recognizing how quickly fortunes can change.
Jones firmly believes that the very best money is to be made at the market turns, even though everyone says you get killed trying to pick tops and bottoms.
So he actively looks for those turning points.
He does. He sees himself as a premier market opportunist, emphasizing that his success often comes from making a series of probes until you finally hit it, rather than a single perfect entry.
Testing the waters until something bites.
Exactly. It's about persistence and adaptation. He challenges the fallacy that markets can be manipulated, arguing that while you can create a stir for a day or two, sustained moves require underlying market soundness.
Can't fake it for long.
Right. He also critically views media outlets like Wall Street Week, suggesting one could probably fade them, meaning trade against their advice. Interestingly, he attributes his mixed success in training traders to the belief that it takes talent to be a good trader, something he never thought that before but now believes is true.
Another vote for innate talent playing a role.
Seems so. The core insight here is that true opportunity lies in challenging consensus and being adaptable, rather than rigidly adhering to popular narratives. Finally demonstrated his absolute conviction. He's pledged 85% of my net worth to his own funds, believing it's the safest place in the world for his money.
Putting his money where his mouth is, literally. Let's turn to Gary Bielfeldt, a modest, soft-spoken trader from Peoria, Illinois, who embodies quiet, consistent success away from the limelight of Wall Street.
Proof you don't need to be in New York or Chicago.
Right. He launched his full-time career with an all-or-nothing play in soybeans back in 1965, turning a $10,000 stake into a doubled equity on a single trade.
Wow, started with a bang. High leverage.
Extremely high leverage position, one that came perilously close to that damaging margin call, but ultimately paid off and set him on his path. This early high-stakes gamble taught him lessons about risk that he never forgot.
Despite having 10, quote, screens surrounding his desk, Bielefeld is remarkably low-keyed, rarely glancing at them. His primary focus is on the fundamental forces driving markets, not the minute-by-minute fluctuations.
Interesting. All those screens, but focused elsewhere.
Yeah. He stresses the profound courage to be able to participate in the markets, citing examples like buying the yen when everyone is bullish the dollar.
Going against the crowd takes guts.
It does. The core insight here is that true conviction often requires going against the prevailing sentiment and having the courage to stand alone. For him, a measure of success isn't just about winning trades, but what I do with the money I accumulate, exemplified by his family foundation, established in 1985, through which he and his family are directly involved in supporting the community.
So success beyond just the trading account.
A different perspective, yeah.
Cool.
Adds a unique dimension to his success. It's not just personal wealth, but societal impact.
His advice for beginners is simple, yet absolutely crucial for survival. It is very important not to get too far behind because it is very difficult to fight back.
Don't dig yourself into too deep a hole early on.
Exactly. He also cautions against taking risks that are too large at the beginning, a lesson many new traders learn the hard way by wiping out their accounts before they've even truly begun.
Sound advice.
The core takeaway from Bielefeld is that conserving capital and maintaining emotional fortitude are paramount, especially early in a trading career. Now, let's meet Ed Seykota, a truly legendary figure whose approach stands out dramatically. Michael Marcus, another market wizard we discussed, described him simply as not only a great trader, he is a mind.
High praise from another legend.
Indeed. His returns are absolutely astounding, having turned a mere $5,000 customer account in 1972 into over 250,000% by mid-1988 on a cash-on-cash basis.
250,000%. That's almost unbelievable.
Imagine that exponential growth over a decade and a half.
Seykota operates from an office in his house, far from the frantic energy of Wall Street, notably without an array of, quote, screens. His trading is largely confined to the few minutes it takes to run his computer program to generate signals for the next day.
Minimalist approach. Runs his program. Done for the day.
Pretty much. An MIT electrical engineering graduate, Seykota views trading and psychology as fundamentally one and the same thing, a profound insight into the inner game of markets.
Trading is psychology.
For him, absolutely. The core insight here is that trading success is not just about systems or logic. It's inextricably linked to one's own psychology and ability to manage internal states.
That focus on psychology is something he truly emphasizes, almost to the point of being a trading psychologist himself. Seykota famously states that pride is a great banana peel, as are hope, fear, and greed.
The classic emotional pitfalls.
Right. These emotions, he argues, are the downfall of most traders. He notes, my biggest slip-ups occurred shortly after I got emotionally involved with positions. And he's got a mantra that every trader should live by, a timeless truth distilled into 3 simple phrases. The elements of good trading are 1, cutting losses, 2, cutting losses, and 3, cutting losses.
He really hammers that home. Cut losses, cut losses, cut losses.
This repetitive emphasis isn't just for dramatic effect. It underscores the absolute non-negotiable importance of managing risk by getting out of losing trades quickly.
When facing losing streaks, his approach is practical and disciplined. He handles them by trimming down my activity, warning that trying to play catch-up is lethal.
Don't chase your losses. Scale back.
Exactly.
Oh, boy.
The core insight is that scaling back during losing periods preserves capital and prevents emotional decisions from compounding errors. He also holds unique, almost poetic views on market behavior, comparing bond prices to how cockroaches crawl up and down a wall.
Cockroaches.
Highlighting their unpredictable yet often patterned movements. He also states that the stock market behaves differently from all other markets, and it also behaves differently from the stock market, meaning easily identifiable patterns seldom exactly repeat.
So patterns exist, but they're never quite the same twice.
That's the idea. This suggests that while patterns exist, one must be adaptable, as no two situations are ever perfectly identical. Ultimately, he firmly believes that good traders have a special talent for trading, implying it's difficult to acquire if not already present, reinforcing Schwager's analogy of the marathon runner.
Another point for the talent camp. Next up is Larry Hite, whose circuitous path to Wall Street included acting and screenwriting.
From showbiz to trading. Interesting.
Yeah. He was inspired by H.L. Hunt's story of achieving windfall profits with minimal risk. This led him to found Mint, a firm explicitly focused on achieving the best growth rate consistent with extremely rigorous risk control.
Risk control first. That's a clear mandate.
Right from the start, it's a significant differentiator.
Mint's track record under Hite is truly exceptional, especially when considering its strict risk parameters. From its inception in 1981 through mid-1988, Mint achieved an average annual compounded return of over 30%.
30% a year is fantastic.
It is, but what's even more impressive is their consistency. Annual returns range from a respectable plus 13% to a best of plus 60%, and their largest loss in any 12-month period was under 1%.
Under 1% drawdown. Over a whole year. That's astonishing.
It really is. This is an astonishing level of consistency and capital preservation, a direct testament to their unwavering discipline in risk management.
And how did they achieve such remarkable risk control, maintaining those incredibly low drawdowns? Hite's philosophy is built on 4 basic interlocking principles. First, trend following. His system never trades counter to the market trend, and they never deviate from our methods.
Okay, consistency and trend following.
Second, limited risk. The maximum risk on each trade is limited to 1% of total equity.
A hard stop on risk per trade. Very specific.
Third, extreme diversification.
Right.
They trade more markets worldwide than any other money manager. Nearly 60 markets across various groups, from stock indexes to agricultural commodities. And they don't just use one system, they employ lots of different systems, ranging from short-term to long-term.
Spreading the risk across markets and systems. Very diversified.
Finally, volatility tracking. They use a 3 lights, system, green, yellow, red, to define when not to play. Stopping trading a market when the volatility becomes so great that it adversely skews the expected return risk ratio.
So they even step aside when things get too wild.
Exactly. The core insight here is that a systematic, diversified, and rigidly risk-controlled approach can generate exceptional returns with minimal drawdowns, proving that capital preservation is central to long-term growth.
Highlights a unique and powerful advantage for the speculator, not having to play. Unlike other market participants, such as commercial hedgers who might be compelled to trade due to inventory or business needs, speculators can choose to only bet when the odds are in his favor.
The power to wait for the perfect pitch.
Precisely. This, he argues, is a significant positional advantage that amateur traders often overlook.
And he emphasizes that markets are inherently inefficient, meaning you can win if you develop a method that places the odds in your favor. His personal turning point, which ingrained this deep respect for risk, was an early pork belly trade that doubled the money, making him feel like a genius. Followed immediately by a near wipeout in corn that brought him back to reality.
Back down to earth fast.
The lessons learned from near disaster, again, proving far more impactful than the wins, solidifying the idea that the most valuable lessons often come from almost losing everything. Let's shift gears now from futures and currencies to the world of stocks and dive into the insights of Michael Steinhardt, a true pioneer in the hedge fund industry.
A legend in the hedge fund world, absolutely.
His firm achieved a remarkable track record over 2 decades, boasting a compounded annual growth rate of over 30% for 21 years, dramatically outperforming the S&P 500.
Incredible long-term performance.
Steinhardt demonstrates extraordinary flexibility, comfortable being both a long-term investor and a short-term trader. He's equally at ease shorting or buying, and he's willing to shift major chunks of his firm's capital into treasury securities when his assessment of the market warrants it.
Very adaptable, not just stuck in one mode.
This adaptability is key to his longevity.
Steinhardt's core philosophy centers on what he calls variant perception.
Variant perception. Okay, what's that?
This means he deliberately takes positions where he believes the consensus is wrong about a particular company, industry, or the broader market. He's looking for mispricing due to widely held but incorrect beliefs.
So basically betting against the herd when he thinks they've got it wrong.
Essentially, yes. Notably, he avoids reliance on charts, rigid stop-loss orders, or even conventional rules about buying on weakness or strength. Instead, he trusts his deep fundamental analysis and is willing to override the trader and liquidate the position if his conviction strongly dictates it, even if his individual traders disagree.
Trusting his own deep research over everything else.
Exactly. The core insight here is that true alpha outperformance often comes from independent, unconventional thinking combined with profound fundamental research and the conviction to act on it, even against the crowd.
He also points out that his firm's profitability stemmed from two key distinct areas, both stock selection, picking the right companies, and net exposure adjustments for anticipated changes in the broad market direction.
So it wasn't just picking stocks, but also timing the overall market exposure.
Right, a two-pronged approach. Micro stock picking combined with macro market timing. He gives a great example from 1973-74, a challenging period for many investors, when he was substantially up, largely because he was net short during a major market decline.
Profiting for the downturn. That shows the power of shorting and market timing.
Being net short means you are betting on the market or specific stocks to fall, essentially profiting from a downturn. This demonstrates the power of macro positioning, not just individual stock hits.
Steinhardt views the traditional buy-and-hold mutual fund approach as too limiting, especially for active managers. He advocates for bringing more things to the table: shorting, hedging, participation in bond markets, futures market trading, to enhance returns and manage risk more dynamically.
Using all the tools in the toolbox.
Exactly. His conviction in his variant perception is paramount, demonstrated by his ability to maintain large positions, like his Treasury note position in 1981-82, even when the market initially moved against him and he faced complaining investors.
Sticking to his guns despite the pressure.
This unwavering belief in his analysis, despite external pressure and short-term discomfort, is a hallmark of his success. The core insight here is that flexible strategies that incorporate multiple tools like shorting and hedging allow for greater adaptation to changing market conditions and can unlock opportunities unavailable to more constrained approaches.
Next, we have William O'Neill, a true self-made success story and a major figure in stock market analysis. He managed to parlay a mere $5,000 into $200,000 in 1962-63 by pyramiding the profits in 3 exceptional back-to-back trades.
Pyramiding, that's adding to winners, right? Takes nerve.
It does. Pyramiding means adding to a winning position as it continues to move in your favor, using profits to finance larger bets. He then launched Investors Daily, now Investors Business Daily, to directly compete with the Wall Street Journal, differentiating his publication by featuring unique statistical information like EPS rank and relative strength.
IBD, known for its data-driven approach.
Exactly.
O'Neill's stock selection model is famously summarized by the acronym CAN-SLIM, a methodical framework for identifying high-potential growth stocks. Each letter represents a key characteristic of successful stocks he identified through extensive historical analysis.
Okay, let's break down CAN-SLIM.
C stands for current earnings per share. He found that the best performers showed a 70% average increase in current quarter earnings, advising a minimum of at least 20 to 50% year to year. The insight here is strong. Accelerating earnings growth is a primary driver of stock prices.
Got it. Strong current earnings. A.
A is for annual earnings per share. Stocks had a prior 5-year average annual compounded earnings growth rate of outstanding performing stocks of 24%. This emphasizes consistent long-term earnings power.
Okay, solid long-term growth too. N.
N represents new. This means a new product or service, a change in the industry, or new management. Crucially, it also refers to a new high price for the stock, challenging conventional wisdom by stating what seems too high usually goes higher and what seems too low usually goes lower.
Buy high, sell higher. Interesting.
That's the idea, the insight. Innovation and positive change combined with price momentum, signal leadership. S is for shares outstanding. 95% of the best performers had less than 25 million shares of capitalization, indicating smaller, more agile companies. The insight. Smaller float stocks can move more dramatically on demand. L is for leader or laggard. The best performers had an average relative strength of 87 before major advances. He restricts purchases to relative strength ranks above 80. Relative strength compares a stock's performance to the broader market. The insight focus on market leaders, not underperformers.
Buy the strong ones, not the weak ones hoping for a turnaround.
I.
I stands for institutional sponsorship. Some institutional backing is desired as they are the largest source of demand, but excessive sponsorship is not because it leads to poor performers when a stock becomes too obvious.
So some big money involved, but not too much. A sweet spot.
Kind of, yeah. The insight. Smart money involvement is good, but oversaturation can signal a top.
And finally, M is for market. 3 out of 4 stocks will go in the same direction as a significant move in the market averages, emphasizing the importance of understanding the overall market trend.
The market tide lifts or sinks most boats.
Exactly. The insight. The general market trend is the most important factor. Don't fight the Fed or the primary trend.
O'Neill also emphasizes the importance of precise timing, advising against buying within the base of a stock's price chart. Instead, he waits for the breakout when a stock's price moves above a resistance level, often a prior high, to minimize the probability of a loss.
Buying on strengths as it breaks out.
Right, noting that if you buy at the right time, a stock usually won't fall to your stop-loss point. He also advises exiting if a stock moves more than 10% beyond its prior price base, even if it's still rising, as this can indicate a temporary exhaustion of buying power.
Interesting sell rule there, not waiting for it to drop.
The core insight. Buy strong trending stocks at precise inflection points to maximize upside and minimize downside.
O'Neill identifies specific market top signals that investors should watch for. These include new highs being made on low volume, indicating a lack of conviction behind the rally.
What warning sign?
Or volume surges, but very little. Upside price progress, suggesting distribution by sellers. Another key signal is when leading stocks, those that spearheaded the bull market, start breaking down.
The generals falling first.
Right. He also notes that the Federal Reserve discount rate being raised 2 or 3 times can signal trouble as it tightens monetary policy. Contrary to popular belief in diversification, O'Neill considers diversification is a hedge for ignorance, preferring to own a few stocks and knowing a great deal about them to better manage risk.
Concentrated portfolio. Know what you own.
That's his view. The core insight here is that concentration in thoroughly researched strong stocks combined with active risk management is superior to broad diversification.
While he himself sells short infrequently, and then only for professionals, he firmly advocates for charts as valuable information that cannot be obtained easily any other way. He sees charts as a visual representation of supply and demand.
A picture is worth 1,000 data points.
Kind of. He also stresses the importance of volume-confirming price action. Volume should increase by at least 50% on new high ground and dry up very substantially during consolidation, indicating healthy price action where the stock is resting before another move.
Volume tells a story too.
Exactly.
Interestingly, given his laser focus on individual stock selection, O'Neill surprisingly recommends mutual funds as an absolutely outstanding way to invest for the long term, specifically 15 years or more.
Really? After all that focus on picking individual winners?
Yeah, it's surprising. He advises a sit-and-not-to-think approach with funds, even buying more when they are down sharply, which is very, very differently from how one should manage individual stocks, where a rigid stop-loss point, a predetermined price at which you will sell to limit losses, is absolutely necessary.
So totally different rules for funds versus stocks.
Completely different mindset required. This highlights a key psychological difference in how people should approach different types of investments. Active management with individual stocks demands rigorous discipline, while long-term mutual fund investing is about time in the market, not timing.
Let's talk about David Ryan, a protege of William O'Neill, who won the U.S. Investing Championship with an incredible 161% return.
Impressive return. Clearly learned from O'Neill.
Definitely. He credits his success to a precise methodology and applying great discipline to follow it. He, like many others, had early losses, particularly by continuing to play as aggressively as I had during the bull market, even when the market entered a bear phase.
Didn't adapt to the changing market.
Yeah.
Common mistake.
Right. He also made the mistake of buying overextended stocks, those trading 15 to 20% above their price bases, after already making significant moves, meaning the immediate upside was limited and the risk of a pullback was high.
Chasing stocks that had already run too far.
Exactly.
Ryan learned from his mistakes by meticulously studying every mistake he made. This commitment to self-analysis led him to become intensely disciplined.
The power of the postmortem analysis.
Absolutely. He closely follows O'Neill's Cancelam methodology, but added his own refinement, focusing on stocks with prices under 30 times earnings and a price-to-earnings PE ratio between even and up to 2 times the S&P 500 PE ratio, finding this sweet spot more profitable.
putting his own twist on the master's method.
The core insight here is that meticulous post-trade analysis and continuous refinement of a proven methodology are essential for turning mistakes into future success.
He asserts that the same types of stocks work time after time and that market behavior hasn't changed at all across decades, demonstrating a timeless consistency in what constitutes a winning stock profile.
Patterns repeat because human nature is constant.
Seems to be the idea. This emphasizes that while technology evolves, human nature and thus market reactions remain fundamentally similar.
Ryan identifies key bear market signals he watches for, including divergence between the Dow and the daily advanced decline line, where the advanced decline line, which tracks the number of rising versus falling stocks, fails to confirm new highs in the Dow Jones Industrial Average.
Underlying weakness.
Indicating underlying market weakness despite headline index strength. He also looks for a feeble, low-volume rally after a market drop as a sign of weakness, suggesting a lack of institutional buying.
A dead cat bounce, maybe?
Could be. His unwavering confidence stems from having a very defined set of principles and a commitment to never stop learning from every single trade. The core insight, a robust data-driven framework, combined with continuous self-improvement, provides the confidence needed to navigate volatile markets.
Ryan finds the entire process of stock selection to be like a treasure hunt, genuinely loving what he does. He even spends 3 or 4 hours on Sunday meticulously going through charts, an exercise many would find tedious.
I love the process, right?
He reinforces the critical importance of a rigid stop-loss rule, risking a maximum 7% price decline on any trade.
Strict risk management again. 7%, that's tight.
This hard limit prevents small losses from becoming catastrophic. He also observes that his best trades are usually winners right from the start, making it easier to cut losers quickly and hold on to winners.
If it's not working quickly, it's probably not going to work.
Seems to be his observation. He meticulously maintains a trader's diary, annotating charts with reasons for buying, liquidating, or adding to positions, which helps him avoid repeating similar trading mistakes, a practice that many winning traders employ for systematic self-improvement.
Learning from every single trade, good or bad.
The core insight, passion for the process, combined with strict risk discipline and diligent record-keeping, are hallmarks of sustained trading success. Our next wizard is James B. Rogers, Jr., a truly independent thinker who famously often holds positions for many years, demonstrating a very different time horizon than many active traders.
Long-term player. Contrasting style.
Very. He humorously prefers the term unemployed over independent trader, despite still actively managing his money across all the markets. Currencies, commodities, bonds, stocks, both long and short, globally.
Trades anything, anywhere. Truly global macro.
He truly believes in seeking opportunity wherever it exists. He got his start as an odd lotter in college, investing his scholarship money. An odd lotter is someone who buys or sells shares in amounts less than the standard trading unit, typically 100 shares. This was usually viewed as less sophisticated trading, but it's how he learned the ropes.
Started from the bottom, learned hands-on. Rogers famously states that he always invests against the central banks, believing that the market is nearly always wrong, and one should never, ever follow conventional wisdom.
Always bet against the house and the crowd. Bold.
Very bold. This contrarian stance is central to his success. He cites the October 1979 Fed policy change, meant to aggressively fight inflation, not immediately moving gold lower, as an example of market hysteria overriding fundamentals for a time.
Markets can stay irrational longer than you can stay solvent, as they say.
Exactly. The core insight here is that conventional wisdom is often priced in, and true opportunity lies in identifying where the market consensus is fundamentally wrong and having the courage to bet against it.
Rogers displayed uncanny foresight, accurately predicting a major, fast, deep, horrible collapse in the stock market for October 1987, even telling John Train in January 1987 that the market would go down 300 points in one day.
Wow. He called Black Monday almost perfectly months in advance.
Chillingly precise, given what Black Monday actually was. He views program trading as nothing more than scapegoatism for the 1987 crash, drawing a parallel to how short sellers were blamed in 1929. For him, the market was simply reflecting underlying imbalances, not a technological flaw.
Blaming the tools, not the fundamentals.
That's his take.
Rogers distinguishes between a financial collapse and an economic collapse, stating that the former can happen without the latter. A financial collapse might be a market crash, but the underlying economy can recover.
Important distinction. Market crash doesn't always equal recession.
Right. He expresses a bearish long-term outlook for the dollar, suggesting it could disappear, like the Argentine peso, potentially leading to exchange controls. He views gold as yesterday's inflation hedge, noting increased production since 1980, which fundamentally changed the supply-demand picture from the 1970s.
Challenging the conventional wisdom on gold, too.
Always questioning. The core insight. Look beyond the headlines and common narratives. True market understanding requires deep fundamental analysis of supply, demand, and monetary policy.
His investment strategy involves patiently waiting until he knows you've got it right, even if it means buying a little bit early, like with American agriculture when it was deeply out of favor.
Extreme patience, waiting for the fat pitch.
This emphasizes extreme patience and conviction. He believes that fundamentally markets haven't changed. The same things make markets go up and down. They have not changed the rules of supply and demand.
Timeless principles. Human nature doesn't change.
This timeless view of market dynamics suggests that human behavior and economic principles remain constant despite evolving technologies. Let's turn to Mark Weinstein, a high-percentage trader. His initial foray into trading was disastrous. He threw his money away with absolutely nothing about markets.
Another one who started with failure. Seems common.
It does. This common beginner's mistake speaks to the necessity of preparation. After working 7 days a week as a real estate broker to save $24,000, he re-entered the market, meticulously learning to chart and using overbought and oversold markets as his method. This time he found surprising success, though he admits it was partly due to luck in favorable market conditions.
Weinstein's current success comes from a highly refined approach. He uses custom-designed, state-of-the-art computer systems to monitor market momentum, combined with comprehensive chart analysis, incorporating various methodologies like cycles, Fibonacci retracements, and Elliott wave analysis.
So a blend of tech and classic charting.
Right. He possesses an uncanny sense of market timing, only trading when nearly everything lines up right. This rigorous selection results in virtually all of Weinstein's trades are at least marginally profitable at some point within 20 minutes of entry.
Wow, almost every trade profitable within 20 minutes. That's incredible selectivity.
Extremely selective. The core insight here is that combining advanced technical analysis with strict selectivity can lead to extremely high win rates, while only taking the highest probability trades.
He aims for quick profits, typically covering trades within hours or even minutes, and leverages a floor network that often puts him on the right side of the bid-ask spread, allowing for even tighter entries and exits.
Scalping for quick gains, using inside info from the floor.
The bid-ask spread is simply the difference between the highest price a buyer is willing to pay, the bid, and the lowest price a seller is willing to accept, the ask. A floor network gives him insight into order flow, allowing him to trade within that narrow spread.
Weinstein's most traumatic trading experience occurred when he let a material goal interfere with his trading, reinforcing a common theme among wizards. It invariably seems to be a mistake to translate the potential profit or loss of a trade into material terms.
Don't trade to buy the car or the boat.
Right, thinking if I make this much, I can buy a car, can cloud judgment. He also passes on many trades that have a high probability but lack his same degree of near absolute confidence, a sound piece of advice echoed by many other traders.
Only taking the absolute A-plus setups.
Seems like it. The core insight. Emotional detachment from monetary outcomes and extreme selectivity are crucial for consistent high-percentage trading.
Let's head to the trading floor with Brian Gelber, a remarkable figure who famously made $4 million in 20 minutes on October 19, 1987, Black Monday.
$4 million in 20 minutes on Black Monday.
Wow, incredible timing. He highlights a basic truth about great traders. Many maintain relatively low profiles, remaining unknown to the public despite immense success.
The quiet achievers.
As a former broker, he observed the basic problem between most brokers and their customers was a mismatch in time horizons and the impossibility of getting information quickly enough to the customer for timely action.
Brokers think long-term. Clients often want short-term action. Yeah, I can see that conflict.
Brokers are generally long-term focused, while customers want fast results.
Gelber acknowledges the inherent conflict of interest for a floor trader who also handles customer orders, admitting it cost me a grand total of $500,000 over a number of years. He firmly states, you can't be a great broker and a great trader.
Gotta choose one path.
He believes one must choose a path to truly excel, as the mindset and demands are fundamentally different. The core insight here is that focus and clarity of purpose are essential. Attempting to serve two masters, like brokering and trading, often leads to compromised results.
He believes good trading involves good instincts and a sixth sense, but clarifies that working hard has nothing to do with it in terms of raw talent.
Another vote for innate ability, or maybe instinct developed through experience.
Could be experience. He stresses the crucial importance of know yourself, to moderate your emotions, to avoid being high as a kite after success or jumping out of a window after losses.
Staying level-headed. Emotional equilibrium.
It's about maintaining emotional equilibrium regardless of short-term outcomes.
Gelber vividly describes the demanding nature of a floor trader's year. 4 out of 12 months you are hot, 2 months you are cold, and the other 6 months you make and lose.
Tricky business, like a hitter in baseball.
Yeah, exactly like that. This cyclical pattern is physically and mentally grueling. The physical and mental stress means you don't rebound as well as you get older, making it exactly like professional sports.
Takes a toll over time.
Absolutely. He grimly estimates maybe 5 or less out of 100 floor traders make $1 million within 5 years, a testament to the brutal attrition rate.
Wow, 5% or less make it big. That's tough.
Very tough. The core insight. Trading is an athletic endeavor demanding peak mental and emotional performance, with an extremely high washout rate for those who lack the necessary psychological resilience.
Moving on to Tom Baldwin, recognized as the most successful floor trader in the world's largest futures market, who quickly became a millionaire in his very first year.
Millionaire in year 1. That's fast.
He defines his trading style with a stark motto: live by the sword, die by the sword, constantly aware of the potential that I could get caught with a big position in a flick move.
Aggressive. High risk, high reward, always aware of the danger.
This illustrates an incredibly aggressive, high-stakes approach.
Baldwin's core profound insight is you have to have a total disregard for money. You can't trade for money.
Disregard money? How does that even work?
He believes that translating gains and losses into real terms, for example, thinking that $1 million could have bought a great house, obstructs rational trading decisions. It becomes about the points, the game, not the dollars.
Detachment again, like it's just numbers on a screen.
Exactly. This emotional detachment is a recurring theme among the top traders. He credits his remarkable consistency from the start to a chart-influenced trading bias, meaning he relied heavily on price patterns. The core insight. True trading mastery requires transcending the immediate monetary implications of gains and losses, allowing for purely rational, unbiased decision-making.
He estimates that less than 20% of floor traders are still around after 5 years, and only 1% become successful enough to keep at least a couple of million.
Even tougher numbers than Gelber's, 1% success rate.
Brutal. This separation, he believes, comes from a lot of hard work, perseverance, and loving what you do, combined with that total disregard for money and almost no fear.
That's a rare combination of traits. Fearless, loves the game, detached from money.
It's a challenging cocktail of traits.
Baldwin readily acknowledges the challenge that increasing size brings. Generally, when you get into a big position, the rest of the floor knows about it, making it harder to enter and exit without moving the market against you.
It becomes harder to hide when you're trading huge size.
Exactly. This is a common hurdle for highly successful traders. He looks for key points in charts, like the high and low for the week, the halfway back point, and consolidation areas to inform his decisions, showing that even fearless traders rely on systematic analysis.
Not just gut feel, there's method, too.
Right. The core insight, discipline, analytical rigor, and an almost superhuman detachment from monetary outcomes are what separate the elite few from the vast majority in high-stakes trading environments.
Our final floor trader is Tony Saliba, an options trader who nearly self-destructed early on.
Another near-death experience.
But he pulled back from the brink by altering his techniques and achieved incredible success. He built his fortune not just on spectacular gains like making $4 million in 72 hours during the October 1987 crash, but on incredible risk control, stringing together an astonishing 70 consecutive months of profits exceeding $100,000.
70 months in a row over $100.
Yeah.
That consistency is mind-blowing, almost more impressive than the big crash win.
Right, that consistency speaks volumes about his risk management.
Saliba started as a spread scalper, aiming to make a quarter or an eighth of a point and average $300 a day.
Tiny wins consistently. What's spread scalping again?
It's someone who makes very quick, small profits by trading the price difference between two related instruments, like different options contracts on the same underlying asset. A quarter or an eighth of a point refers to very small price increments, often fractions of a dollar in options or futures. This disciplined approach taught him to be regimented and disciplined in handling rapid small transactions.
Learning the ropes with small, fast trades.
Exactly. He gained notoriety as one lot because he traded in incredibly small positions, often getting in their way of larger traders, but adhering strictly to exchange rules.
They called him one lot, like an insult.
Probably started that way, yeah. But this rigid discipline, even in the face of derision from other traders, was fundamental to his early success. The core insight: mastery of small, disciplined trades can build a foundational understanding of market dynamics, leading to consistent profits and preparing a trader for larger opportunities.
His strategy is based on anticipating all the what-ifs through hard work and homework, meticulously working out what-ifs by hand, not relying solely on computers.
Scenario planning. Thinking through every possibility.
This exhaustive preparation, visualizing all possible market scenarios, allowed him to take advantage of situations such as the October 19 stock slide, instead of being immobilized by the chaos that gripped many other traders.
Preparation meets opportunity, even in chaos. Saliba rejects the dramatic Success magazine portrayal of his 1987 crash actions, clarifying that he was in the office that day due to concerns about his clearing firm and a specific trader's huge position, not to deliberately avoid the floor.
Setting the record straight, it wasn't just luck or avoidance.
Right. He also mentions he sold a seat that day, meaning he sold his membership on the exchange floor, which could be quite valuable, clarifying he had 7 seats, and it was a rare round turn in one day trade on a non-liquid market.
Selling an exchange seat on Black Monday? Bold move.
A round turn means both buying and selling a position within the same trading day. A non-liquid market is one where there are few buyers or sellers, making it hard to enter or exit positions without significantly moving the price. He attributes those who got buried in October to taking for granted that it would be a normal day, buying every dip, and then freezing in the face of unprecedented price action.
Complacency and freezing up. Deadly combo.
The core insight: thorough preparation, scenario planning, and an awareness of systemic risks allow exceptional traders to capitalize on extreme market events while others are paralyzed.
Saliba emphasizes that the reality is far less glamorous than a shoot-from-the-hip approach, stressing that exceptional traders owe their success to hard work and preparation.
Demystifying the genius myth: it's hard work.
This demystifies the image of the spontaneous trading genius. He learned that when he strays from that discipline, it usually ends up costing him, citing a $10 grand loss from not having orders in while on a business trip, highlighting that even small deviations from discipline can be incredibly costly, reinforcing the unwavering importance of adherence to one's rules.
Discipline isn't optional, it's essential. Every time.
Now we enter the fascinating realm of the inner game, the psychology of trading, with Dr. Van K. Tharp, a renowned research psychologist.
The mind game. Crucial stuff.
Dr. Tharp developed the investment psychology inventory to measure winning and losing traits. He argues that when people approach markets, they bring their personal problems with them and act out those problems rather than actually solving them.
Wow, so the market becomes an arena for our personal issues.
That's his argument. This is a profound statement, suggesting that trading can reveal our deepest psychological patterns.
Tharp identifies several primary psychological impediments that keep most people from becoming winning traders. The first is dealing with risk. Most individuals are risk-aversive in the realm of profits, meaning they tend to take small gains quickly, fearing the profit will disappear.
Grabbing small wins too fast.
Yeah. Conversely, they are risk-seeking in the realm of losses, letting small losses grow into large ones, hoping for a reversal.
Holding on to losers way too long. Sounds familiar.
It's classic behavioral finance. In essence, they do the opposite of what is required for success in trading. Tharp suggests viewing trading as a game where a mistake is not following the rules. This reframing can make it easier to cut losses and let winners run by removing the emotional sting of being wrong.
So a mistake isn't losing money, it's breaking your own rules.
Exactly. Powerful reframing. The core insight here: our natural human biases often lead us to make precisely the wrong decisions in a probabilistic environment like trading.
The second major impediment is dealing with stress. Stress, Tharp explains, leads to worry that consumes decision space in the brain, causing people to narrow their focus and revert to earlier well-practiced response patterns.
Stress makes us revert to bad habits, basically. Tunnel vision.
Yeah. This might mean deciding not to decide at all, or simply following the crowd because it feels safer. And as he powerfully states, crowd following is a sure way to lose money in the markets, as the crowd is often wrong at market turns.
The herd is usually wrong at extremes.
Right.
Tharp has identified several core beliefs that distinguish top traders from the rest. They believe they control their own results, taking full responsibility for their outcomes.
Ownership, no blaming the market.
They believe mistakes are a way to gain feedback, not a sign of personal failure. Crucially, they believe that losses are essential for trading, viewing them as an unavoidable cost of doing business, like electricity for a factory.
Losses are just part of the process, expected.
Expected and accepted. Furthermore, they believe that their models don't have to be perfect to be profitable. And finally, they believe there is always another trade, which helps them move past losing positions without emotional attachment or dwelling on past missed opportunities.
Abundance mentality. Always another bus coming along.
Exactly. The core insight, a resilient and growth-oriented mindset, coupled with a systematic approach to learning from setbacks, is fundamental to sustained trading success.
This sounds a lot like what we might call justified confidence in your approach.
Exactly. Tharp defines justified confidence in trading as coming from three key components. 1, a constellation of beliefs like those we just discussed, which form a strong psychological foundation. 2, extensive testing of some sort of model, ensuring the strategy is robust and understood. And 3, an extensive commitment to being successful as a trader, signifying deep dedication.
Beliefs, testing, commitment. Makes sense.
He points out a natural tendency to blame something other than ourselves when things go wrong in the markets. However, he advises that the best approach is to determine how he or she produced those results and give yourself other options to take when you encounter a similar choice point in the future, focusing on internal agency rather than external blame.
Learn from it, figure out how you caused it, and plan differently for next time.
Exactly. The core insight. Genuine confidence in trading isn't born from ego, but from a robust belief system, rigorous testing, and unwavering commitment to personal mastery.
Schwager himself shares his own quest for self-discovery in the book's prologue, prompted by his sense of failure as a trader despite being consistently profitable.
Even profitable, but felt like a failure. How come?
He realized his great errors included taking far too small initial positions in trades he correctly anticipated, essentially missing out on big wins.
Leaving money on the table. Underbetting his good ideas.
Right. And then a highly premature liquidation of those positions. He would often take profits on the first leg of a price move, hoping to re-enter on a correction, only to see the market run away on the upside from the sidelines, leaving him in agony and missing the bulk of the move.
Cutting winners too soon. Just like Marcus's painful soybean trade. Common psychological trap.
Exactly.
This deep self-reflection led him to vow change in his own trading. He recounts a silver Swiss franc trade where he initially placed the order at the exact worst possible moment as the market peaked right after his entry.
Ouch. Bad timing.
Terrible timing. However, drawing on his new resolve, he decided to maintain my position and, following his new conviction, even doubling up the position on a correction, which proved good.
So he overcame the initial mistake with discipline.
He did, initially. Yet this newfound discipline was quickly tested. A snap judgment to stay with the trade without doing the necessary work, influenced by the external pressures of a new job and writing this book, led to him giving back a significant portion of my earlier gains.
Discipline slipped under pressure.
Easily done. This personal anecdote powerfully illustrates how easily discipline can waver, even for someone who intellectually understands what's needed, especially under stress or external distractions. The core insight, even for experts, maintaining discipline is a continuous battle, and external pressures can easily erode even well-established rules.
And this personal experience, this ongoing struggle with his own trading psychology, brought him back to Ed Seykota's profound statement. Everybody gets what they want out of the markets.
Meaning, we subconsciously get the outcomes we expect, or maybe even desire, even if it's losing.
That's the implication. It implies a subconscious fulfillment of one's inner beliefs, even if that means repeatedly losing money. It suggests people might subconsciously sabotage themselves to fulfill an underlying pattern or belief.
Deep stuff.
Schwager recounts a friend who made $18 million but refused to take any out for safekeeping, saying, "I need all the money for trading."
Wow. Didn't want the security, wanted the action more.
This extreme example perfectly encapsulates Seykota's principle. The friend subconsciously wanted the excitement and challenge of the game, perhaps more than the security of the money itself, showing how deep-seated psychological motivations can override rational financial decisions. #see dreams and the subconscious in trading.
The book even touches on the fascinating, almost mystical relationship between dreams and trading. It suggests dreams can be the means by which our subconscious penetrates the barriers we sometimes erect in accepting the true analysis of a market.
Dreams telling you what the market's going to do. Sounds a bit out there.
Well, maybe not predicting the future directly, but perhaps reflecting your subconscious analysis. For instance, if you're fundamentally bullish on a market but hesitating to enter a rising market, perhaps due to ego or an unwillingness to buy at higher prices because you missed the initial move, your subconscious might be trying to break through these mental impediments.
Okay, so the dream reflects the analysis you're consciously blocking.
Possibly. A vivid dream about the market running away on the upside could be its way of nudging you towards accepting the reality of the trend and acting on it, free from your conscious biases. The core insight here is that our subconscious mind can process market information and patterns on a deeper level, occasionally providing intuitive guidance that bypasses conscious rationalizations and emotional blocks.
Interesting thought. Your gut feels manifesting in dreams. Before we move to our final thoughts, it's worth briefly clarifying some of the options terminology we touched upon, especially with traders like Tony Saliba. Understanding options is crucial for grasping many advanced trading strategies.
Absolutely. They can seem complex, but the basics are pretty straightforward. At its simplest, an option is a contract that gives the buyer the right, but not the obligation, to buy or sell an underlying asset, like a stock or a futures contract, at a specified price, the strike price, on or before a certain date, the expiration date.
Right, but not obligation. Key difference.
Huge difference. Call options give the buyer the right to buy the asset. Put options give the buyer the right to sell the asset.
Calls for buying, puts for selling. Got it. What about risk?
Now let's look at the risk-reward, because it's very different for buyers and sellers. For the buyer of an option, whether a call or a put, the risk is limited to the premium paid for the option. That's all you can lose.
Okay, define risk for the buyer.
Right. The potential gain, however, can be unlimited if the market moves significantly in their favor. This is why they are often used for speculative bets or hedging existing positions.
Limited risk, unlimited reward potential. Sounds good. What about the seller?
The seller's side is the mirror image. For the seller of an option, the potential gain is limited to the premium receipt.
Oh, they can make.
But the risk can be unlimited for a naked call or put if the market moves strongly against them. However, sellers often have a higher probability of making a small gain if the option expires worthless or moves favorably.
Unlimited risk, limited reward, but higher probability. Okay, different trade-off.
Very different. Options also have different values components. Intrinsic value. This is the immediate profit you would make if you exercise the option right now. For a call, it's the stock price minus the strike price, if positive. For a put, it's the strike price minus the stock price, if positive.
The real value it has right now.
Exactly. Time value. This is the portion of an option's premium that is attributed to the amount of time remaining until expiration and the volatility of the underlying asset. The more time an option has until expiration, the greater its time value, as there's more opportunity for the underlying asset's price to move.
Value based on time left and expected future movement.
Right. And these combine into how we describe options. In the money, ITM. An option has intrinsic value. For a call, the stock price is above the strike price. For a put, the stock price is below the strike price, at the money, ATM. The strike price is equal or very close to the current stock price. These options have no intrinsic value, only time value. Out of the money, OTM. An option has no intrinsic value. For a call, the stock price is below the strike price. For a put, the stock price is above the strike price. These options are purely time value and expire worthless if they don't move into the money.
ITM, ATM, OTM. Got it.
Understanding these basics is key to appreciating the complex strategies that options traders like Saliba employ, such as the spread scalping he used, which involves simultaneously buying and selling different options to profit from small price discrepancies while limiting overall risk.
Helps understand how they manage risk using options. Hashtag final thoughts and the timeless wisdom of markets. As we conclude this deep dive, it's striking how, despite the diverse methodologies employed by these market wizards, ranging from purely technical to purely fundamental, and with holding periods from minutes to years, Schwager identifies several key commonalities among them.
Yeah, common threads despite different styles.
These aren't secrets hidden away, but fundamental truths that underpin their extraordinary success. First, they all shared a driving desire to become successful, often overcoming significant obstacles and early setbacks.
Passion and persistence.
Second, they possessed an unshakable confidence that they could continue to win over the long run, a belief in their own process and resilience.
Self-belief, grounded in method.
Third, each found and stayed true to that approach, with discipline being the most frequently mentioned word across all interviews.
Discipline. We hear that a lot.
Fourth, they took trading very seriously, devoting a substantial amount of their waking hours to market analysis.
It's not a hobby. It's a serious profession requiring hard work.
Fifth, rigid risk control was a cornerstone of virtually all their strategies, preserving capital above all else.
Protecting the downside. Always.
Sixth, they showed patience to wait for the right trading opportunity, refusing to force trades.
Waiting for the fat pitch. Not trading just to trade.
Seventh, they consistently emphasized acting independent of the crowd, avoiding the emotional pitfalls of groupthink.
Contrarian thinking, or at least independent thinking.
Eighth, they universally understood that losing is part of the game, viewing losses as unavoidable costs or learning opportunities, not personal failures.
Accepting losses gracefully.
And finally, they all genuinely love what they're doing, which fuels their dedication and perseverance through challenging times.
Gotta love the game.
Seems essential.
22 years after the book's initial publication, Schwager reflects on the timelessness to market truths. He asserts that the markets are a reflection of human nature, and the constancy of human emotions explains why the same rules that applied when Market Wizards was published still apply today, as they did a century earlier, and as they will a century from now.
Technology changes, platforms change, but people don't.
Exactly. This underscores that while technology, access to information, and specific market instruments evolve, the underlying psychological forces driving market behavior remain constant. Fear, greed, hope, and pride are enduring human traits, and understanding their influence is key, regardless of the trading platform.
Building on that timeless wisdom, Schwager offers another profound insight, echoing the musician Claude Debussy's observation that music is the space between the notes. Schwager suggests that, analogously, the space between investments, the times one is out of the market, can be critical to successful investing.
So knowing when not to be invested is as important as knowing when to be invested.
Precisely. He cites an example of a manager who achieved cumulative gross returns in excess of 800% over a 12-year period when broad equity indexes were essentially flat. How? By not being invested during negative environments, thus sidestepping most of the large drawdowns.
Avoiding the big losses makes a huge difference over time.
The critical lesson here is that it is important not to be involved in the market when the opportunities are not there. Knowing when not to trade, when to preserve capital, can be as crucial as knowing when to trade and often leads to superior long-term returns.
The power of patience and selectivity again. And finally, let's touch on intuition, a concept often misunderstood and given little respect, especially in the analytical world of finance. Schwager clarifies that intuition in trading is experience-based.
Not magic, but pattern recognition built over time.
Exactly. It's simply subconscious experience, where a trader senses a bullish or bearish direction without being able to explicitly articulate the reason. It's a subconscious recognition of a similarity between the current situation and past markets that the conscious mind hasn't yet fully processed.
Your brain seeing patterns you don't consciously realize.
That's the idea. This isn't magic. It's the culmination of thousands of hours of market observation and pattern recognition. If you find that your intuition is more right than wrong, the advice is clear. Trust it. It's a powerful tool for those who have put in the hours and built that subconscious pattern recognition through rigorous study and direct experience.
So develop it, test it, and if it works, trust it.
Okay. And as we conclude this deep dive, consider this. If the markets are truly a reflection of human nature, and the core psychological challenges of pride, fear, hope, and greed remain constant through time, what specific emotional biases or tendencies might you be inadvertently bringing to your own decisions?
Yeah, not just in finance, right? It's not just in finance, but in any area where risk and reward are at play. And how might understanding these market truths, the power of discipline, the acceptance of loss, the importance of patience, and the critical role of self-awareness empower you to act with greater clarity and intention, even when the crowd is shouting the loudest and your own emotions are urging you to do something else?